What is the main drawback of the payback period method? A. It does not account for the time value of money. B. It is too complex.
C. It ignores the initial investment. D. It always gives a negative result. Answer: A. It does not account for the time value of money. Which capital budgeting method adjusts for the riskiness of the project by discounting future cash flows? A. Payback period. B. Accounting rate of return, R. C. Discounted payback period. D. Internal rate of return, IRR. Answer: C. Discounted payback period. In capital budgeting, what is the profitability index, PI? A. Ratio of total cash inflows to total cash outflows. B. Ratio of present value of cash inflows to initial investment. C. Difference between NPV and initial investment. D. Ratio of operating profit to total assets. Answer: B. Ratio of present value of cash inflows to initial investment. Which method of capital budgeting provides a measure of how much value a project is expected to create? A. Payback period. B. Net present value, NPV. C. Internal rate of return, IRR. D. Accounting rate of return, R. Answer: B. Net present value, NPV. When comparing mutually exclusive projects, the project with the highest __ should be selected. A. Payback period. B. Net present value, NPV. C. Accounting rate of return, R. D. Initial investment. Answer: B. Net present value, NPV. If a project's IRR is higher than the company's cost of capital, what does this indicate? A. The project should be rejected. B. The project will decrease the company's value. C. The project is expected to generate returns above the cost of financing. D. The project has no impact on the company's value. Answer: C. The project is expected to generate returns above the cost of financing. The discount rate that makes the net present value, NPV, of a project zero is known as A. Payback period. B. Profitability index. C. Internal rate of return, IRR. D. Accounting rate of return, R.
Answer: C. Internal rate of return, IRR. What is considered a major disadvantage of the IRR method? A. It is difficult to calculate. B. It may give multiple values for non-conventional cash flows. C. It does not consider the time value of money. D. It ignores cash flows after the payback period. Answer: B. It may give multiple values for non-conventional cash flows. In capital budgeting, what is a project's terminal value? A. The final cash flow of the project. B. The sum of all cash flows. C. The value of the project's cash flows beyond its initial forecast period. D. The total initial investment of the project. Answer: C. The value of the project's cash flows beyond its initial forecast period. Capital structure refers to A. The mix of a company's long-term debt, short-term debt, and equity. B. The allocation of resources among different departments. C. The structure of a company's board of directors. D. The organization of a company's workforce. Answer: A. The mix of a company's long-term debt, short-term debt, and equity. Financial leverage refers to A. The use of debt to finance a firm's operations. B. The use of equity to finance a firm's operations. C. The use of retained earnings to finance a firm's operations. D. The reduction of operating costs. Answer: A. The use of debt to finance a firm's operations. The Modigliani-Miller theorem states that, under certain conditions, the value of a firm is A. Dependent on its capital structure. B. Independent of its capital structure. C. Maximized by using 100% debt financing. D. Maximized by using 100% equity financing. Answer. B. Independent of its capital structure. What is the primary benefit of financial leverage? A. Reducing the cost of equity. B. Increasing the potential return on equity. C. Eliminating business risk. D. Reducing the cost of debt. Answer. B. Increasing the potential return on equity. Which of the following would likely increase a firm's financial risk? A. Increasing the proportion of debt in the capital structure. B. Issuing more common stock. C. Increasing retained earnings. D. Reducing operating expenses. Answer. A. Increasing the proportion of debt in the capital structure. The degree of financial leverage, DFL, measures A. The sensitivity of operating income to changes in sales. B. The sensitivity of earnings per share, (EPS), to changes in operating income. C. The overall risk of the firm. D. The variability of cash flows. Answer. B. The sensitivity of earnings per share, (EPS), to changes in operating income. A company with high operating leverage typically has A. High variable costs and low fixed costs. B. Low variable costs and high fixed costs. C. Low total costs. D. High total costs and high variable costs. Answer. B. Low variable costs and high fixed costs. Which of the following is a measure of a firm's operating leverage? A. Debt to equity ratio. B. Degree of operating leverage, DOL. C. Return on equity, ROE. D. Current ratio. Answer. B. Degree of operating leverage, DOL.